Hey everybody, this is Jose Blasco. We are about to get started in a minute. Let's have a quick sound check. Please go ahead and type on the chat box a quick hello. That would tell me that you hear me, and therefore we are ready to get started. Apart from, as I always say, being a nice thing to do, to say hi to your peers and have this beginning message for the session. So 40 seconds to go, guys. Please go ahead and confirm sound is good. I believe it's all fine. But again, always good to get technicalities out of the way so we have a smooth session. I will put myself here on the bottom right side of the screen to say hello from here. How are you, everybody? Christian, good morning. How are you? Very good to see you from New Mexico. Amazing. Very good. Everyone, good to see you as well, guys. So we have 5 seconds to go. So we are basically ready to get started. 1-0. Here we go. Top of the hour, everybody. Welcome to the session. Today it's November 10, 2021. This is Options with Options. My name is Jose Blasco. We'll be obviously looking at the options markets, trading the options, finding the opportunities, talking about trades that we are running, looking at the markets, all of that. But before we get started, as always, financial disclaimer on the upper left side of your screen. Please read it carefully. It's just a couple of paragraphs. It's not too long. But really, read it completely, please. It is indeed important information, so please do not skip it. Read it well. Thank you so much for that. And as we cover the disclaimer, so now it's also time to cover the agenda. So what's the plan? Well, we're going to be looking at the market. Then we're going to be looking at trades that we have and discuss if anything needs to be done or not from a trade management point of view. And from there, see how much time we have to find new trades and execute those trades. Typically, on the Wednesdays, we have limited time for trade executions. We have more time normally on the Thursdays. Again, every week is different. But this is kind of like the pattern that you would see if you attend our sessions regularly. So, let's see how it goes. Even though, to be honest, today, from a trade management point of view, it should be quite short. So hopefully we'll have a bunch of trades before we are done. Maka, good to see you. Clive, good to see you. Everyone, very nice. Cool. Okay, so let's get rid of the introduction slide. Let's begin getting organized. First thing I'd like to do before we start today is I'd like to point at our website. In this case, I want to point at the apps section of the website. We have apps, courses, and coaching. I would like to point at the apps section of the website, if you don't mind. Why is that? Well, because we use trading technology to plan our trades. The technology that we use is supported in multiple platforms: TradingView, MetaTrader, TradeStation, and Top, the Traddictiv Options Planner, which obviously today being an option session, Top is obviously the tool that we're going to use the most. And this is where you will need to come to subscribe either in a monthly basis or a yearly basis. And again, you got certain benefits, as you can see: coaching plan, access to all courses are included. You guys take a look. And if you have any question, please email our support team and they'll be glad to clarify anything that you may need to become a top trader. Apart from that, we also have our page, tradewithufos.com/Jose. In this case, could be /Jose, could be /Becky, could be any of your instructors. And this is what I would call the question page or the help page, where you can come in here and add a title for your questions, add a description, insert images, pictures of your charts, pictures of the option chain, the risk profile graph. Anything you are getting from Top, for example, you can put it in here, send and submit that question. And then here in the bottom part, we're going to be adding more and more of those questions, and therefore the answers as well, building this database of questions and answers where next thing you know, you have a question, and instead of just sending the question and waiting for the response, you can just search, and odds are that your question may be here, and you can basically save time, and it's good for you. You get your answers. It's good for the community. Because now everybody gets the answers of questions that may not have thought yet, and the day they think about it, so the answers are waiting for them. So anyway, so this was a little bit of a reminder of things that probably many of you know, but also we often have a new member joining us that may not know with precision what we do, and it is indeed important. Anyway, so Let's begin with the charts. Let's begin with the planning, the understanding of the markets. And the first thing we're going to do is to look at the S&P as always. So the S&P continues in this unbelievable climate, 19 candles into a climate where statistics would have suggested 6 is a normal thing to happen. So in other words, Christian, you posted 2 questions and they disappeared. That's very weird. Christian, I will take a look at that, okay? And I will let you know tomorrow if you don't mind. This is indeed strange. So I will look at and see if it was an issue on our side because we have spamming software and all sorts of things on the website. Last week, I don't know if you guys noticed, but we suffered 2 DDoS attacks in a row. So our website was, under pressure, if you wish. So all good so far, but there was some pressure last week, and maybe our protection software there went a bit too far with your questions. Okay, so I'll take a look and I'll let you know, Christian. Ahmed, good to see you. Maka, same for you as well. Okay, so I definitely need to review that. I will get back to you guys tomorrow. Okay, sorry for that. Mark, good to see you. Yes, indeed, Maka, it's helpful, and well done that you guys are sharing this with me, because I wouldn't be aware if it was not the case. Great, thanks a lot, guys. So again, coming back to the markets, okay, the climate, spectacular. This is kind of like the word that would come to my mind, representing something that based on probabilities is totally unlikely, but it's happening, right? So again, what's the expectation? The expectation is for that climate to change, but so far it's not taking not even a breather. I mean, 3 candles of going sideways to gap down today, but then it's going back up and basically trading flat. So we'll see what comes next. But I would say that we are now seeing, which was not the case before, we are now seeing a pretty intense drop in momentum, as you can see. Even though the calls seem to be a bit higher than the puts, we can see that there is a pretty intense drop of momentum. And also, if we look at the volume map, so you can see 1.1, 1.2, 1.3, 2.3, but in this case, 2.3 on the put side. Okay, so, and on the short-term expression, we are below average volumes in all those, weekly expression cycles. So, lots of indecision on the options market. If you wish, a little tiny bias to the upside, with implied volatility for the calls pointing at 12 versus the puts, gray color, pointing at 1167, but very tiny, very tiny. It's nothing major, which kind of confirms this loss of momentum. So what's the expectation? Well, again, the expectation would be for the market to go red, begin a down climate for a couple of days, and then restart pushing to the upside. That would be the expectation. Having said that, same I said last week and the week before, when a market goes to a stage where we are now, where what's happening, it's real, it's not a joke, but it's totally out of what probabilities would have suggested. The reality is that having any bet in any particular direction, it's, I would say, a low probability bet, because you cannot rely on stats that are objectively broken at this moment in time, even though stats tend to be met most of the times. That's why they are stats. With the moment they are not being met, and in this case the divergence is massive from 6 to 19, isn't it? So really you cannot rely on it. Even betting the market is going to fall, why? I mean, all of this has been happening and is already very unlikely, so it may continue for a few more days. Market could, all saying in Wall Street, the market could remain irrational longer than you could remain solvent, isn't it? So again, we cannot fight those things and have this strong bet like, the market is crazy, whatever. So no, the approach this week, same as the prior weeks. Let's try to find some longs, let's try to find some shorts and profit from all of those. Or use some of those trades to hedge other trades, instead of having only one bet, only one direction, and on top of that, because we are very convinced this is crazy, next thing you know, the bet is way too hard. Okay, so we are not going to fall into this trap. This is kind of like, that would be emotional trading. Many people fall into these kind of things. This is why I'm spending a decent amount of time to phrase things that I could summarize in 2 words. But at the same time, I want to make sure you understand, because then session is over. Tomorrow you are trading, you are on your own, it's your computer in your room, you close the door, and then sometimes, those temptations will happen at a subconscious levels, and you don't realize you're making a mistake while you're making it. So I want to make sure I get you thinking, so you put yourself in that position and you understand the importance of keeping your mindset objective and cool. And even when stats are totally broken, they're still stats and they're still telling us something, which is now it's not predictable to have a strong bet in any direction. Okay. Anyway, Christian, here's one of my questions. When setting up a trade, why not go for the 55 straight to 1 day, 2 day, 3 day if probability is low on the lower time frame? I have noticed the probability is typically higher on the 2 and 3 day time frames. Yes, you're correct, Christian. And the reason why is because, again, everybody in the group has a different style on how to trade. And as a rule of thumb, entering with a lower time frame will add more precision because your entry price zone is going to be narrower. So both on the entry, but also as well on the stop, if you were to use stops. So you're going to have more precision. So it's always kind of recommended, even though it may take more time of planning and analysis, it's always recommended to go for the lower time frame in the sense that you are becoming more precise with the entry. And this helps with both the reward and the risk, meaning that you have a more precise entry. So when you get to the target, you travel further, or if you're going to hit your stock, you travel less far. Again, with the option trades that we do, we are not using stops. Okay, we use option strategies that got limited risk. Therefore, we are not using stops. So in this sense, you would also say, so why? I don't care. Let's go ahead and use the 2 day time frame. The 3 day time frame is going to give most of the times greater probability compared to the 55-minute time frame. So let's be pragmatic and do that. And if you do that, it's fine. But again, if you were to find the entry on the 55, you probably add a little bit more precision to the entry one more time. And even though you may not plan to use stops, as I said, if you use limited risk strategies, you could indeed not use stops and you still have your risk under control. But now, thanks to using the lower time frame, you may get into a trade, when the market dropped just a few more cents, and then maybe let's say you do a credit trade, for example. So now, next thing you know, you got a little bit of a greater premium or credit for this trade, which again, when you do that many times throughout the year, it counts. So, as a rule of thumb, I think it's a healthy approach to go from a lower time frame to a larger time frame. But I could also understand for the ones of you that have less time to be in front of the screen, that you go the pragmatic route where, this is why we build the 2 day and the 3 day timeframes on top, which is not available in many other platforms. The majority don't have that because it gives you more probabilities. And then, not only you have this option to have more probabilities, but you can also make yourself more pragmatic, which for the very busy people, it's not wrong. Okay, so Christian, long story short, what you said is totally valid. My preference will still be go through a lower time frame first because of the benefit I just mentioned. But what you said, it's correct. And if you were to do that, it's absolutely not an issue. Okay, cool. Okay, so S&P, again, we have that climate that we discussed. We have the implied volatility of the calls slightly tiny, almost no difference with the put. So very undecided type of market. And then on top of that, we got multiple UFOs below price. So there is not much room for the S&P to fall really, unless something very strong to the downside is going to happen. Okay, so I would expect the market to again change to red climate for a couple of days, which is exactly the same thing I said last week and the week before, and I was totally wrong. But it's still my expectation because I need to rely on something tangible, which is the probabilities, and that's the case. Now, this is not a very useful analysis given the fact that what I said is that the probabilities basically invalidate the fact that the probabilities have been broken, invalidate whatever odds in your favor you would have to either go long or go short. So therefore, the approach is going to be the same as we had the last week, which is let's find longs, let's find shorts, put that in the portfolio. From a VIX point of view, the VIX is higher than the last week. So we are trading at 1726 real time. So that is good in the sense that we may be able to find some non-directional trades with a little bit more premium compared to the last week. And this probably corresponds with the fact that the market started falling for 3 days. And that probably scared many people, or maybe didn't scare many people, but you got some profit taking there. And that, gave the impression to people that there was, a little bit of a sell-off coming in the market. And many people started buying protective puts, and then the VIX went up. So again, ideally, we have that push to the downside. That would be so healthy because then the market will normalize. You can bet more strongly to the upside. And on top of that, if the market goes down, volatility would rise a bit, and that was going to make your life easier for the non-directional trades. But we don't have that yet. So then the approach is, with this market condition, best thing you can do, find a few longs, find a few shorts, find a few non-directional trades, and build out the portfolio in a way where you are managing and balancing out your Greeks. In this particular case, you can see I got -4 delta, 5 vega, -4 theta. So the idea, at least on the vega and the theta side, to try to get this much more neutralized. And then on the delta, pretty much neutralized as well, because we don't have a clear directional bias. But the moment the market decides or defines itself with a healthy climate, then that's when you want that delta to point either to be positive or negative, depending if you are bullish overall or bearish overall. Okay. But anyway, so we'll talk about that in a moment when we start looking at new trades. In the meantime, we also need to talk about positions. And here, I don't have too much to do because I have done a lot this week while we were not in the session. But I do want to share what is it that I've done, because we had multiple trades that were doing things that were relevant. So I'll start with Pfizer, okay? And I did comment on that on Sunday, if you were with me on the top session. But Pfizer had a beautiful, massive rally, okay? Beautiful, massive rally. If we go back to the 2-day time frame, okay? While we entered somewhere in here, and it was very disappointing because Pfizer went against us all the way, look at what just happened, okay? Amazing. And this actually implied that we hit our target. So I had to exit this particular trade, okay? So now, what is it? Okay, what is it that we have in our hands? Well, let me go ahead and get to a risk graph. So you will see what is it that I have done, what is it that I have, because if you look at my account, Pfizer is not here any longer. So I closed it. That was a few days ago, last week. But I want to tell you exactly what is it that I have done. Hopefully you have done it too. On Sunday, I suggested to get out. Mark, I remember, said, because we are beyond the target, I have a stop where the target was. So if it keeps going, I may make some more money. So all of this is valid. But at the same time, there were other implications with this trade that I want to comment, okay? So now, let me compare spreads so I can show you what is it that we had and what is it that we have. And wait a minute. Yeah, no, I cannot do that. I cannot do that. Let me explain it here. So first of all, what we had with this trade, okay, if you focus on this side of my screen, okay, let me zoom in. So what we had was two, notice we got two, okay? We got two of the bull put spread made of selling the 43 puts and buying the 42s. And then on the upper side, okay, all of these here, okay, all of this here, that was +1, -2, +1. This is a call butterfly, buying the 47, selling 2 of the 48, and buying the 49, okay? You got out at 48.5 mark. Wonderful. Good job, my friend. Good job. So now, in other words, we have two bull put spread paying for a butterfly. This was entered in pieces. It was not entered in one shot at the same time. Okay. And, if we were still in that position, okay, notice what the P&L would be. Okay. And in other words, if you compare the P&L with the P&L I have when I close my trade, which is 316, okay, so why is that? Okay, how come? Well, if you recall, the risk profile of a butterfly has a triangle shape. And what happens with the triangle shape? What happens with the triangle shape is that the place where you make the most amount of money is when you get to the midpoint of the triangle that was 48. The moment you surpass the triangle, you start losing profitability. And if the stock was to rally even more like crazy, let's say all the way to 50s, 51, whatever, so then the amount of profit you will make is actually less than what you would make if you had gone to, let's say, 47.5 only, okay, where you would make a greater amount of profit, okay? This is the risk profile of any strategy that has a triangle shape. And the consequence, and that's why we always said, and I persisted and insisted in prior sessions, that the best place where to get out is, where the midpoint is, which is in this case the 48 strike, which is where we had the two short calls. Okay, this is where we had the two short calls. So we had multiple orders in the system in this case, where we had orders to close the short calls at 5 cents. I want to see if I find this easily on my computer, guys. If you don't mind, just give me 1 second. So let me see. That was on the 5th of November when I closed the trade. Okay, in my case. Yeah, 5th of November, exactly. So we had an order, if you recall, to close those 48 calls at 5 cents. Okay, we had an order to do that. We also had an order to close the bull put spread. Okay, we also had an order to do that. Do you guys remember that? That we had the bull put spread buy to close order as well as the 48 call buy to close order? Yes, Christian. The answer is yes. You should have had a conditional order to get out at 48. Reality is that I would understand that you didn't have it because the speed of movement of that stock was quite unpredictable. I mean, we knew Pfizer is a stock that belongs to a strong industry. So in this sense, this is something that we've seen before. I don't know if Tim is with us today. If not, Tim, you may be watching this recorded, but Tim sent me a very nice email a few weeks ago where his sharing was, well, what I really learned is that, you get into those trades with stocks that belong to strong industries, and the trade may not work at first, which in this case was, that S&P going down for multiple weeks, right? But then when everything go back to normal, those stocks that belong to the strong industries, next thing you know, they push like crazy. And, to him, that was a big aha moment, something he has never noticed before. Basically he fell in love with the matrix and all the grouping that we have built in the platform to be able to identify that and, have higher probability bets and also faster speed movement towards your target when you're right. So this movement, okay, was not easy to predict. From that day when the stock closed at 43.85 to next day where the stock opened at 48.9, that's like a 10% gap up. And it was, yeah, for sure, we got the earning date here, but the earning date was even before that. So this was probably, quite news driven in the sense that, so this company, released a new pill, a new drug, all of those things, whatever that is, whatever indirect force was happening behind the scenes in the market, the fact is that this move was very unpredictable. And if it caught you without the order in the system, for sure, this could happen to everybody. Okay. But at the same time, if you are looking at your accounts in a daily basis or something like that, you could have reacted to it because, the opening price in this case was 48.09, right? The low of the day was 46.55. So you have a few opportunities to get out around 48. And by the way, we don't need to be that precise. Okay. Yes, Christian, exactly. That was the test that was successful. You're right. So anyway, so again, we had the order to close the puts. We are the order to close the calls. Of course, with this massive move up, what happens to the calls? They gain plenty of value. So we wanted to close the calls, but it was not possible at the price we wanted. Okay, but what happened to the puts where the puts were closed immediately? Why? Because we got to even better prices that what we wanted to shoot for closing those puts, thanks to the 10% gap up. Okay, so what I did, and in here, is to kind of summarize. Okay, actually I have it here open. Here, what I did is kind of summarize. You can see my flat line P&L pointing at $316. This is the net result of my trade, and what I've done is to kind of summarize the exit prices of the trade together with the entry prices of the trade, all together. So you can sorry guys. So you can see some of those closes. Notice I got rid of the puts from here, and the reason why is because there is a maximum number of rows that you can have on a risk graph, and if I add the puts, they would not fit. So I decided to get rid of the puts because I get everybody understand what happened to the bull put, right? So you close the bull put, when the market go up at a lower price and you make a profit on the bull put. So what I've done is I took that profit, okay? That's why you can see the fill price for this trade is zero, because I took the profit from the bull put and I spread it, that profit, across the options that we bought, which were calls, to have a simulation that is accurate from a monetary point of view. And then basically what's really important here is that you notice that the exit part of the trade are those three final rows where I bought back the 48 calls at 5 cents. Actually, you don't remember this well. I ended up closing them at 5 cents. Then sold the 47 call at 198 and sold the 49 call at 114. And altogether, with the fact that my initial trade cost me that net, it cost me more. But when I add the put profit together with the call cost, it would be like that. So then I ended up with a profit of $316 per contract, which I guess that depending on when you close the trade during that day or the day after, you may have made 300, 275, 400. It's going to be around that value. But that's what I got. And the move was so spectacular and it was happening, and I wanted to show you guys that. And also, when a move is so strong in one direction, often it bounces back in the opposite direction. So I had to close the trade without waiting for the Wednesday, so I can explain that to you today. Hopefully you guys appreciate that. So you guys, please share on the chat box, how it was for you guys. I know some of you already closed the trade. Hopefully everybody is out. If you are not out of the trade, just keep in mind that stock is currently trading at 48.98. The ideal, area for profit is 48. So if you want to watch it manually and maybe it drops intraday or something and it comes closer to 48 and you want to close, that's fine. Holding it for longer, it's not a good idea, because if you hold it for longer and this is what you got in your hands, okay, and the stock happens to not to stop at 49, but the stock happens to rally all the way to, let's say, 52, next thing you know, you're going to be left in a position where instead of making around $300+ of profit, you will end up with $14 of profit on expiration. Okay, so this is not a trade. When you are doing butterflies, when you are doing any risk graph that has a triangle shape, you don't profit the more the further the stock goes. It's not like when you buy a call where the more it goes, the more you profit. Keep that in mind. You got to reverse gamma the moment you surpass 48, and then you start losing delta until delta's maybe inverted. Okay, so just keep that in mind. And again, you close it whenever you choose, but ideally, the closer to 48, the better. Okay, cool. Let me see. Mark, you got out 48.5. I'm just reading your questions, guys, and comments. Maca still in as usual. Okay, we need we certainly need to improve on that, and that's something I need to do better myself. Okay, when it comes to giving you a bit more anticipated rules on when to exit trades, which in this case, again, it surprises all that it gapped 10% in one day. But indeed, hopefully, this is kind of like the day where this sticks forever, because we talked about it last week and today, with the 10% gap, this comment that I made about those triangle shape risk profile graphs. Remember, the ideal point where to exit is the midpoint of the triangle, in this case 48. So that should be an alert, a triggering alert, an order, whatever you want to do. But if price gets there, you have to consider getting out. My call to sell never triggered, the puts did. Okay, Christian, I get what you mean. Mine may have triggered at 5 cents because it's a demo account. You always get a little bit better price feels. But having said that, I have to say it was not an order to sell the calls. It was an order to buy back the calls at 5 cents. Okay, so it's an order to buy the calls back, not to sell them. Okay, and I know it's just because you type it like that. Okay, we are human, not a big deal. But just because this is sensitive and delicate, I just wanted to say it so it's crystal clear for everybody. Christian, so if we have a triangle shaped profit zone, we should always enter a conditional order, right? A conditional order is not a bad idea, but when you are dealing with option strategies with multiple legs, like a butterfly, where you have 4 options contracts involved, if your conditional order ends up executing a market order for you to get out, you may get slippage on 4 legs, and that may be worse than just having an alert. Just set yourself an alert on TradingView, and the alerts on TradingView, they reside on the server side. So if you get there, you're gonna get a push notification on your phone, and then you just go in there and you close the trade manually, looking at the bid-ask spread, try to get the mid, try to not to suffer much slippage, and exit healthily. In my mind, unless you're trying options on Microsoft of the SPY, which are amazingly liquid, I would say it's a better approach to set an alert instead of a conditional order that gets you out. Okay. Having said that, certain platforms, and we'll need to talk about this in the top sessions on the Sundays, we're a bit far from that, my friends, but certain platforms have conditional orders where you have some intelligence built in, where you can have a conditional order that doesn't send a market order. It's a conditional order that sends a limit order that is pegged to the midpoint of the spread and things like that. So we will need to talk about those things for sure. As you're waiting for this conversation to take place in the room, you can certainly contact your broker. I'm sure they have videos on YouTube on how to do those things, and you can certainly take a look, okay? But again, probably the best idea, keep it simple, guys. Just a push notification on your phone. Use TradingView. It's simple, it's amazing, it's free, it's on the server side. I think it's a great way to do it. For the ones of you using TOS, alerts are always also held on the server side. Not in the case of TradeStation, but it is the case with TOS, okay? Nice. Maka, so what's the plan now? Since I'm still in, the plan now is to get out. That's the plan. And ideally, you get out the closer to 48 as possible. So something you may want to do is chart an intraday time frame with that stock. And if it starts falling, just let it fall, because the more it falls, the closer it gets to 48. But if you see that red UFOs start being broken on the intraday time frame, just get out and collect a profit, and that's it. Okay, and let's not be greedy and turn what a profit is into, a $14 profit then. Okay, so I'm not saying that that's your intention, but also it's very easy. Greed is a human emotions that could happen at any moment to anyone, right? So make sure that you got that under control. Mark, you made $340.22. Congratulations, my friend. That's very nice to hear. Mark, if the 47 and the 49 call options were all had left, wouldn't they be worth more the higher the price goes? Yes, indeed. If that was the case, they would be worth more. Okay, you are correct. And then you can write it, or you can sell calls against those calls now that the market went higher to lock in profits, like what we did with Lily months ago, for example. Okay, this could also have been done. Maka, yes, but that means you are at your desk for the time when it triggers. Well, yes and no. Yes, because yes, okay, but at the same time, if you think about it, you getting filled with a market order and gives you slippage is going to remove some of the profitability, where you getting a push notification on your phone, and if you happen to not to be at your desk, you go take a look at the trade, let's say 2 hours later, and then you negotiate your exit properly and you save on the spread, but maybe you missed a little bit on the timing because it took 2 hours for you to look at your computer. So it's kind of the same. So it's not that big as a problem. And then most importantly, if you use a platform with advanced, I know you use TOS, Maka, so we'll talk about that in proper sessions. In the meantime, again, you can contact TOS, ask them for support, look at their videos. So they have places where they explain how to do that, because each broker is different. Okay, but certainly I will cover TOS. And with your broker, you can actually set orders with conditional, with conditions, but on top of that, be more precise than just using a market order. That can also be done. Okay, so it's a matter of you knowing how to place these type of orders. Christian, alerts, got it. Yes, I bought the calls back. Sloppy of me to say otherwise. Not an issue, Christian. We keep each other accountable. I make mistakes too, isn't it? So it's all good. It's not a big deal at all. Okay, it's just I wanted to phrase it so in case someone got confused, it's all clear. You put conditional order on the calls. Okay. Mark, just to clarify, the conditional orders on the call, you mean the calls you bought back? or the other calls, the 47 and the 49? Okay, which ones? Please confirm that to me. Joe, the ask was 006 during the session. Anything can happen with pharma. Get out when you can, when you have, or not when you have to. Yes, indeed. It's a good point, the one you bring in, because different sectors, different stocks. In the end, they have their own personality to a degree. While a stock is a stock and it follows the stock market and the sector. In the end, there are clear cases. I mean, look at that. The market didn't jump 10% up, and Pfizer did. So there are cases where stocks got life on their own, and some stocks do that all the time. Well, not 10%, I guess, but some stocks are more aggressive than others. So stocks that belong to pharma, biotechnology, things like that, they tend to be very volatile. So, you may have an order waiting to get filled at 5, but you may see that what happened today was quite spectacular. You are 1 hour before the close and you see that option is trading at 6 cents. You know what? Just close it at 6 cents, even if that also means that you're going to pay a commission. It's okay. It's fine. So, Joe, I'm with you. Again, common sense, you want to add common sense to your trading plan, because while our trading plan needs to be rule-based and we should be mechanical and never break the rules, again, there are cases where you need to overlay a little bit of common sense on top of your rules, which are also common sense, because again, your rules, you may not have a rule to what that says what to do when it's 30 minutes from the close, right? And maybe you do, and then you don't need. But if you don't have that rule, maybe doing what Joe is suggesting makes sense too, okay? Maka, that is the purpose of the mobile app. Yes. That's a good point as well, Mark, where you can exit as well using your mobile. But again, I also get Maka. I mean, I have a baby at home, for example, so there are times where you just cannot. You have one of those days and you just cannot, or you have a job, you have other responsibilities. So I get it, okay? But at the same time, you gotta trade in a way that is compatible with your life. So if we are doing pretty advanced trading, which implies pretty advanced management, somehow you need to be ready for having a solution to make time when it's needed. If that was not to be the case, maybe you need to tweak your trading plan to be a bit more on the passive side, maybe use larger time frame, maybe be not do certain tweaks, such as getting into strategies that give you triangle shapes, which have great benefits, but also have, like everything in life, pros and cons. So what is the great benefit? Well, if you recall, Pfizer at a time was a losing trade, right? So not only we recover it, and of course Pfizer went back up, but even if Pfizer didn't go as high, we would have ended up with a profit. Okay, we locked in, if I'm not mistaken, a $14 profit no matter what. So again, we saved the problem thanks to doing what we do. But now, what's the trade-off? Well, the trade-off is that now you have a triangle-shaped risk profile, which means that if the stock goes to the infinite, it's the same as if the stock went to the infinite against you, right? So the sweet spot is to get in the middle of the triangle, okay, or as close as possible to that. So that implies a bit, being available to do that when that happens, okay? So, it's, again, it's a collection of things, guys. You guys are learning. There is more to learn, by the way. You guys are learning as well about yourself, the trader in you, as you trade, and especially when you add real capital. And as you are gaining experience, learning about you, learning about the markets, understanding your life, your responsibilities, availability for time, and so on. So what you should be doing is tweaking your trading plan in ways where what you do is 100% in line with you. So it's all good, and do it in a way. If I can add one more advice, do it in a way that you are not a perfectionist. Okay, I am. So I know what I'm talking about. Don't do it in a way where you're a perfectionist. Do it in a way where you are pragmatic. Pragmatic means 20% of the effort, 80% of the result. That's what it means. In other words, if today you missed an exit or today you missed an entry, it's okay. It's not the end of the world. You don't get upset. You don't get in revenge mode. You don't get, so you gotta have this type of mindset so you can trade relaxed. Because if just because one day you cannot comply with one of your rules, which we should, like 99% of the times, but if there is this 1% of the times where you cannot, so you gotta make sure that you take it easy on yourself, because this is the recipe to trigger certain human emotions which could be problematic, where now you want to take other trades to recover, now you are upset, now you feel lack of confidence, now you feel down because you don't feel you have done a good job. Again, there are so many consequences. I don't want to get into that because I'm already spending too much time with Pfizer, even though those are priceless comments, I would say, at least to me. If I was to meet the trader in me, the Jose trader, over a decade ago when I started learning how to trade, and I was to teach myself that to me would be priceless. So hopefully this is helping you. But at the same time, I can tell, because I am, when you are a perfectionist, often you don't pay attention to that, or you don't give it the importance it has. So make sure your plan is as adapted as you as possible, as rule-based as you can. The rules to be strict, the rules to be followed. But then if there is any deviation, because we are human, it's okay. Don't be hard on yourself, or be like, oh my God, that's it, that cannot be, because whatever. Because then you can never trade. Okay. I had a very good conversation with a friend the other day as well, who also trades. He's also a perfectionist. I guess we attract each other. And so he was building a business plan for trading, where he was thinking, okay, so here's the result of my backtest. This is how much I make. So if I spend X amount of time trading, and I take this amount of trades per day, and I make this per week, and this per month, and this whatever, so this is the capital I need to trade, and therefore I reach my goals, and blah, blah, blah. You know what? It's a great approach. But that is not taking into consideration the human component. So what if one day you don't feel well? What if one day you lost internet connection? What if one day, it doesn't happen often, but you took 5 losses in a row, and then for the rest of the week you decide not to trade because you totally lost your confidence? So how do you recover from all those things? So you need to have business plans, trading plans, rules, where you are tolerant with yourself, where you have a cushion that allows for, today I was not able to close the trade on time. Today I was not able to trade because my computer, was not booting. Today, whatever, because we are human. So you need to find that balance. And that's why I'm using the term pragmatic, because we need to be perfectionist as much as we can, but we are human. So it doesn't make sense to be that perfectionist, because we just cannot. There is always something that will happen. And if that's going to impact you in a way where now you feel bad, you feel whatever, so then it's too much of a problem, okay? So anyway, hopefully you get my point, and that is making sense. And I can see we have Virgos in the room, and Joanne is laughing. Got it. Yes, you can set the getting out, okay? And again, one good rule, right, is at least a rule that serves well to feed the feeling that you are doing what you're supposed to be doing, you're doing a good job, you're a professional. One good rule is, if you are supposed to be out of a trade and you're not, just get out. And therefore, the rule for you to get out is go on TOS now, right-click on closing the trade, pick the midpoint, and try to get filled on the midpoint. That's it, okay? So that's the rule. Again, another way to approach it is, as I was saying, maybe you go to the 8-minute time frame, okay? In here, okay? And you turn on the UFOs, or you watch the chart. For example, this is the high of the day, okay? So if it surpasses the high of the day, you close the trade. If it starts going down and it starts producing UFOs, you just trail it, and the moment it turns up and violates one of the UFOs, just get out. Okay, just get out. And then you are as close as possible to that 48 mark, which is here. So, using the intraday time frame may give you a way to have a little bit more profitability. Again, pros and cons. Now you have to watch it, okay, which not everybody may be able to do that, okay? Good. Mark, finding a balance can take a long time. Yes, but it all starts with kind of acknowledging what I said, okay? When it comes to, we're human. Joanne, you're laughing on the perfectionist comment. Yeah, because you know me that I'm not perfectionist, isn't it, Joanne? Mark, thank you so much, my friend. This is very appreciated. Anyway, let's continue. So I'm going to get rid of the Pfizer rows here, and I'm going to be looking at the next trade, which is KBH. Okay, so KBH is also a trade where something happened. Okay, so with KBH, that stock, continued moving against us. It never started moving down. But if you look at what I have on TOS with KBH, the only thing I'm left with is two puts. I am long the 39 put and I am long the 35 put. And this is not what we had. Okay, this is not what we had. With KBH, what we had is this. Okay, that's what we had. Okay, we had two of the 37 put, and then we had the 39 put above and the 35 put below. So again, that's a directional put butterfly. Okay, this is the directional put butterfly that is supposed to make money on the way down if the stock decides to fall, which it hasn't, or at least we went from an initial, okay, an initial 39.33 bear put spread, okay, to closing the short puts to be left with a long put only, to converting this to the directional put butterfly, to then placing an order together on the last session to close those two puts at 5 cents, which we did. Okay, I got filled, I can tell you exactly the day. For the KBH, I got filled on the 9, so that was 2 days ago on Monday. Okay, and therefore, when that took place, okay, so that, those 37 puts are gone, and therefore we are only left with the 39 and the 35, because again, the 37 are gone. Okay, so what's the result of doing this? Okay, and let me do the midpoint. So the result is that if we did nothing, it would be $177 of risk. If we converted that into the butterfly, it would have been 160. Now doing the last week would be 145. So we keep shaving and shaving and shaving, right? And now, of course, if the stock keeps rallying, so then forget about it. It's not like we can do so much more, even though I'm going to try. But if the stock falls, now you're going to profit at the speed of two puts, where if you look at that risk profile, again, this is unlikely because it's very far. But if the stock was to fall from the current price, which is 42.39, to the break-even, which is 37.35, so next thing you know, now you are making potentially unlimited amount of capital, which of course is not going to happen because it's very unlikely. But you never know. So good news, we're in a position where we limited our risk to the maximum. The maximum this trade now can lose is 165. That's the worst case. The trade started with more risk than that. And now if you have a drop, now we're going to profit faster than before. So that's the good news. Bad news, this is not good, okay? Because it seems that we are locked into the red territory, which again is the consequence of a market that went against you. And it's going to be very difficult to fix, given the fact that we're dealing with November 19 expiration, which is next Friday. I mean, the Friday after next Friday. And there is not that much time for us to sell, whatever we can sell. That is going to be significant, okay? So let me take a look at the option chain just in case, okay? I'm going to look at KBH. We're looking at November 19. I'm going to be looking at the strikes. So we have 39 and 35. That's what we have, okay? We are using the puts, okay? So if we look at what we have here on this side of the equation, so notice how there is no bid, okay? There is no bid, and the ones here are 5 cents. So again, there is nothing that we can sell between 35 and 39 that could bring in anything interesting. Okay, there is nothing. So in that sense, it seems that so far, this trade is looking like it's going to end up losing those $165 unless the stock starts falling. And if it starts falling, the good news is that now we have two puts working for us. So next thing you know, we end up with a, if we have an authentic crash on the stock, so now we end up with a really beautiful profit. So, nice to be in that position, even though this hedging trade did not help at all, okay? Now, it was a hedging trade. So we just made $300 with Pfizer. If we lose 165 with this one, that's what a hedging trade is for. So this is not necessarily bad, even though, of course, I'm always trying to help the trades to the maximum to get those trades, become as profitable as possible. Okay, and the last one, guys, COF. Okay, so with COF, I also had an execution that took place during the week. And I documented it here, so you can look into it, okay? First, let's look at the chart, okay? So here's COF. So we entered COF using the 3-day time frame. If you recall, what we did with this trade is that we sold puts using the 140 UFO. So we sold puts down here, collected credit, and then we bought a call. And that was the trade. Okay, so this was the trade. So we sold those two puts, okay, 2 units, sold the 139.4, which lining up with 140 UFO, bought the 134 below. Okay, that was 2 of them, collected credit and used that to pay for the 174.4 call. So that was the trade. Okay, now what happened? That market rallied, and as the market rallied, if you recall in the prior session, if I'm not mistaken, because it's many trades, but if I'm not mistaken, in the prior session we calculated what was the value we wanted to close those puts at, so we would be left with a call that has no risk. Okay, if I'm not mistaken, we did this calculation, and if I am mistaken, well, then I did this calculation myself someday during the week. Hopefully I remember well. I'm not sure right now as I'm saying it. I may have done that myself. But anyway, in any case, so here is the end of the story. Okay, and if you have not done it, you can do it now. Okay, because that market is actually higher than when I did it myself. So you would end up in a better position than myself. So what did I do? Okay, so take a look because I documented this here properly. So first, this is the original trade. Okay, in blue color, I sold 2 of the 139 put, bought 2 of the 134 put, and bought the 174.4 call in exchange. This is the original trade in blue color. What is it that I did? So green color. I closed the puts. So notice the puts, right? The 139, 134. So the one I sold, I bought it back. The one I bought, I sold it, right? And here are my field prices. In case you want to use that as a reference, I would suggest you take a screenshot, because if you still have this trade in your account, you can close it, and you should, I would say for sure, get better prices than me. Actually, I can simulate that if you do it now in a moment, so you can get the real-time prices as well. But if you want to compare the real-time prices with what I got, this is your time to take a screenshot. So I closed the put side, so then I was left with a call only, a call that would have no risk, okay? But since that stock moved so far, so fast, and I am aware that the S&P is in crazy condition and it may turn and become red, even though it hasn't, but it could happen anytime, and it could be aggressive, because what's happening is statistically unsustainable, so going down could be quite sharp. So what I did immediately to protect myself is I sold the call against the call I had. So I had the 174 call, and I sold the 179 again against, collecting new $149 of credit by doing so. So what's the net result of doing that? Well, the net result is that even if the stock goes to zero, I am locked in a $26 profit no matter what. Currently, the P&L is 78. 78 where my mouse is. The current P&L is 107. Okay. And if the market was to rally, okay, and surpass, the long strike, which is 174.40, so now I will be in a position where I could make up to $500 per contract. So worst case, I make 26. Best case, I make 526. Okay. So that's the trade I have in at this moment in time. Okay. Now, if you did not do this trade because you were not in front of the screen, you didn't think about doing the math, so how could you do it now? Well, I'm just going to copy it, and what I'm going to do is I'm going to edit my field prices, and I'm going to make them mid, so then you'll be able to see how much you can get sorry, I didn't do this right. Let me do it again. So it's the 3 rows in the bottom what I should do exactly. So let me see. Yeah, sorry guys, I was about to make a mistake. So close the 2 puts, close the 2 puts. Yes. Close the puts. 1 second, guys. I am missing 1 put. Sorry, let me double check this. Maybe I made a mistake when I entered this. Let me double check, guys. Sorry for that. I got 2, 2. Yes, this is not correct. No, it is correct. It is correct. Okay, sorry, guys. Sorry. You know what got me confused is that because we just talked about the Pfizer trade where it's closed, I was thinking about this simulation at its close, but it's not closed. What's closed is the put side. The call side is open. So here we go. So what I closed is the put side. So if you didn't close it, you can close it now at the midpoint. And what I did is I entered a short call, which if you want to enter it, you can enter it now at the midpoint. Okay, so here we go. So this is what you would get if you do it now. So you can see the orange graph is above my blue graph. Why? Because I did it a few days ago. Since a few days ago to now, COF went higher. So if you do it now, you're gonna get a better feel for that. So if you do it now, worst case, you're gonna make $67 instead of 26, which is my case, right? And that's worst case. And best case, instead of making 526, which is my case, you will make 567. Okay. So in other words, if you are in this trade, so let me maximize this so you can take a good screenshot so you can execute that after the session is over, because the session is almost over. And by the way, I cannot execute it because I'm out, but you could. So if you haven't, again, one more time, on the upper part in blue color, I'm showing you what you should have in your account, which is the puts and this call. Okay, and on the bottom part, using green color, I'm going to highlight what is it that you would get with the mid prices if you exit the put side, and what is it that you would get if you add a new unit to the trade, which was not there before, which is selling the 179.4 call against the 174 call that you would be left with the moment you close the put side. Okay, so currently you have 3 units, 2 puts, 1 call. If you close the puts, you would be left with 1 call. So what I've done is sell a call against the call you have. And that call is the 179 here in the bottom. Okay, so notice how I got mid, mid, and mid. Those are the 3 legs that you need to act on. Okay, the 2 above with the put is close the puts. The 1 below with the sell is sell to open a new call against the call you have. So you close the puts for 73. Okay, so let me see what would a closing price for those puts be. Okay, if we do it at midpoint, okay, closing the puts, should be, I mean, that's 2 units, okay, so it's half of that. So if I make it 1, just so you get to see the real-time prices. So if I do 1, so it's 75 is the midpoint. So you got 73 mark. So very good job, my friend. Very good job. And for opening the call, that one we can see here. So 169, the midpoint, you got 154. So I would say there you may have left a little bit on the table. I would guess, unless the price has moved quickly in the past few minutes, maybe you could have got just a little more than 154. But definitely on the put side, very good execution with 73 versus 75. Very, very nice. So good job. Okay, good job with that. Okay, if I was to use your values, Mark, if I was to use your values, okay, you got 154 for the call, and then for the put, you got a total of 154. Okay, so what I'm going to do is I'm just going to pretend this. Okay, just like that. So that will do. Okay, and therefore this will be your risk. No, this is not correct. Yeah, of course, it's not correct. I cannot do it like that. you will need to give me the field prices that you got there for me to, because you only gave me one. So you will need to give me the field prices for me to be able to enter this properly. Because the fact that there are 2 units is distorting it if I do it like that. Price did just move fast. Got it. Perfect. Perfect. Anyway, I guess it's clear, guys. I guess you got it. I took my time to go over this, okay? When I saw that the Pfizer conversation was going to be a long one, so I decided to take my time with trade management, so tomorrow we don't have to talk about this. So, love the selling put strategy. You mean the buying back the put, correct, Christian? We are saying the same, because to be honest, you sell one, you buy one, but really the exit is buy back the bull put spread. So that's why I'm saying. Kind of joking, okay? Anyway, so here's what I'm going to do, just to make it very, very clear and easy to understand. So, well, I guess it's good enough. So that way we have all the history of this trade documented here. So I'll just leave it like that. Now, notice if I had not done this tweak, I would be making 152. In this case, I'm making 108, but my benefit the other day was, the concern that, price may turn aggressively to the upside, to the downside. So I was wanting to lock in whatever P&L was available at the time to get me in that position of worst case, I make $26. Okay. So yeah. Yes, Christian, when we started the strategy, we sold the bull put spread. You're right. I was kind of joking now, okay? Because, earlier it was a one thing, but now it was, anyway. That type of humor that sometimes I have, that sometimes is better than others. But anyway, my friends, we just hit the top of the hour, so we're done for today. Tomorrow we'll continue. We indeed have very little in our account at this moment in time with COF, KBH, which basically is a dead trade. So basically we got 2 things, okay, as you can see, and therefore are really eager in the following sessions to add a bunch of trades, so you guys can learn and practice and everything else. So thank you, Christian. Thank you. Very appreciated, my friend. You guys, see you tomorrow. Again, keep up the good work. I will be looking into those posted questions that did not show up, and I will let you know tomorrow, guys. Okay. See you tomorrow. Take care, everyone.